After finding a sector that you want to invest in, it's of course always important to look into the companies more in depth to see if they're actually worth buying. That's exactly what we're doing today with Fission Uranium. Hey, my name is Tucker Krause, and welcome to my channel. In today's video, I'm going to be taking a look at Fission Uranium and seeing if they are a good buy in the uranium space. Though, of course, I'm going to continue doing analysis of multiple different companies so that we can compare these companies against each other, more so than just their basic deposits, like I did with my uranium mining comparison, which I'll have a part 2 coming out this Thursday. Also, make sure to go watch the first one if you haven't already. Click that right up here or here, one of the two. We'll see where I put it. Also, of course, make sure to do your own research. This is for entertainment purposes only. Now, let's get right into the company.
Today we're finally going to be doing another good old-fashioned stock analysis. Today we have Fission Uranium. I have both their Toronto and over-the-counter exchanges here, depending on which one you want to purchase. With only a market cap of $261 million, they of course have a lot of growth potential compared to, say, a Cameco, who is worth several billion dollars, but that also means they're a lot more risky due to their small size. So, first up, I just want to look at a couple of snippets from their presentation. But before that, I just also want to note I have price per pound here as well in Canadian US dollars, just because they're not profitable at the moment, so no point in putting a non-existent PE ratio there. So first up, this goes over some of their shares outstanding details and things like that, and major shareholders. So some things I don't like here is they have extreme amounts of share dilution here, right? We see they have over 50% more shares outstanding than just their market cap, which I'm definitely not a fan of. I'm not a huge on companies diluting their shares a whole bunch. Another thing is the management and board only holds 0.5% of the company. If they were really confident in the company, they'd be wanting to hold a lot more of the company. So that doesn't really make a lot of sense to me. I would like to see that be at least, 5 to 10% minimum. So not a fan of that. It probably has something to do with this heavy share dilution. Another thing to note, though, is that they do have a significant amount of their company owned by CGN. So that does show something, since that, of course, CGN is, of course, one of the largest and probably one of, or if not the most important uranium company, since they do basically everything for China. So that's definitely notable that they own so much of Fission. I just want to note something here that could maybe explain why there's such low CEO and board ownership and such large amounts of shares outstanding, since Fission Uranium Corp is spin-out after spin-out, with Denison acquiring a lot of their other assets and possible mergers with Denison, etc., etc. You can see right here, their project is actually very, very shallow compared to a lot of the other projects in the Athabasca, which is nice because it means that, of course, they don't have to spend nearly as much to get it out of the ground because they don't have to dig nearly as far. So just quickly going over their timeline, we can see they're still working on feasibility studies and other statements and things like that, and they plan to start construction in 2026. Specifically, this breaks it down a bit more in depth. Right now, they are currently trying to increase their mineral resources and reserves, and of course they need to continue working on their feasibility studies and ESG type stuff until they can start construction, hopefully in 2026. And that is the assumption I use, 2026, for the discounted free cash flow. We're not doing that quite yet. Quickly looking at the project overview here, I just took some from the project overview section of their website. We can see here that they have a large deposit of 81 million pounds of uranium at a extremely high grade of 1.61%. Sure, a lot lower than someone like Denison, but obviously significantly higher than pretty much every non-Athabasca deposit. We can see they do have high capex here, over $1 billion in total capex, and just under $1 billion in initial. So that does show almost all the capex is initial and not quite in closure and things like that. So at least they're, going to be getting it out of the way earlier on. Their OPEX is very low at only $7.18, and their construction is expected to last 3 years, and they're expected to produce for 7 years. So it'd be nice if they're going to be producing for a bit longer. That doesn't seem all too long. And the other thing is that because the mine goes online in 2029, they may miss out on producing during this uranium bull market, depending on how long it goes for. I'm not sure if it's going to last that long, but it could mean they'd be bought out by a larger company, say Cameco, that produces during the bull market and is going to need new assets, because I think as far as I know, a lot of their deposits don't have a whole ton of years of production left. At least they're currently producing ones, or ones that are ready to produce at the basically flick of a switch. So I've got a discounted free cash flow set up here, assuming a couple of different uranium spot prices. So at current prices, they're of course going to be significantly overvalued. At current prices, they're actually worth net in the negatives, which is really not good, right? Since that just means the company should be theoretically non-existent. But when we look at $60, right, that's kind of the standard prediction for uranium spot price per pound you see people putting out there, and we see that they are actually significantly undervalued with well over a double here. Though, of course, that doesn't factor in things like just the mania that could surround a giant uranium bull market that could push it up into being overvalued territory like we're seeing with tech stocks right now. Though, of course, you don't want to bet on that sort of thing. That's going to be too risky. And so they are currently trading at as if uranium was trading at $49.30 per pound. Right, we can see right here, if spot price was $49.30 per pound, they'd be trading at fair value right now. But of course, it isn't. We're significantly below that. So of course, you want to buy in on this company depending what you think the uranium spot price is going to be. If you think it's not going to pass this threshold of $49.30, of course, you want to avoid the company. If you think it will, like I do, it could be a decent buy. But of course, you want to compare that to other companies because this is only a double, or that's not a good way to put it, only a double, but compared to what some people are predicting. So you may want to look at other companies that maybe are going to be more undervalued than Fission. So comment down below which other companies you'd like me to take a look at. Right now, I'm thinking of looking at Global Atomic next. But either way, thanks for watching. Again, comment down below which company you would like to see next. Though next week, I'm thinking I might actually look at a little bit of Platinum Company since it's the most undervalued precious metal. But now I'm rambling. I will see you next time.